Hello and welcome to another video as part of the technical analysis series. We've got a very heavy topic today. We're going to be talking about trade management. Usual routine for those of you familiar with the series. The outline for today's video is as follows. We'll start with a quick disclaimer, move on to some general remarks about trade management, focus on the definition and the specific context that I'll be relying on for this video. Then the bulk of the video will focus on a trade management framework, which will be split into the categories that you can see there, and then we'll round off with some trade management psychology and tips, and then a conclusion. Usual disclaimer, please pause the video if you have to familiarize yourself. Neither this presentation or anything on my Twitter, Telegram, or any other media mode of communication, including private correspondence, constitute financial advice. This is for entertainment purposes only, as boring as it may seem. So some general remarks about trade management. So it's one of the more psychologically challenging elements of a trade. It's probably one of the last things that developing traders think about, or when you're just starting out, when you're learning all these cool tools for entries and these cool techniques, indicators, actually managing a trade from A to B is not something that really comes to mind until you find yourself in a live environment. You're staring at the chart and wondering what on earth you do now that the position's been opened, right? And there's a spectrum between set and forget and active management. So you see this kind of wisdom parroted a lot that, oh, if you're stressed about your trades, you should set and forget, which I don't entirely agree with. It's certainly not a one-size-fits-all approach. At the same time, you get traders who have fantastic swing trade ideas. You know, they can draw it all, do all the squiggly lines, risk-reward tools, but then when it comes to babysitting the position or just holding it from A to B, they end up losing their shirt. Okay, so that kind of spectrum between those two extremes worth investigating, both in terms of your data, your journal, your own research into how you perform. I think it's also trading style dependent, as mentioned or alluded to earlier. You know, how much set and forget are you going to be able to do if you're scalping a tick chart versus swing trading a weekly chart, right? Quite different. And on a similar theme, timeframes as well. Different timeframes lend themselves better to active or passive, if you will, management. And that is something we'll look at throughout this video as well. Trade management is where good trade ideas go to die. As dramatic as it sounds, I'm sure it's happened to you. It still happens to me, happens to fantastic traders that I know, where trade ideas, which are beautifully laid out, simply do not fully come to fruition, where trade management gets in the way. You either cut too early, move your stop too early. There are a million things, as you'll find out during the course of this video, you can do to mess up an otherwise fantastic trade. So developing a framework for trade management is a big part of bridging the gap between analysis and trading. Now, a recurring theme throughout this entire video, it will get repetitive, but I think this is something that never really goes away, is that it's important as technical traders, or as speculators generally, to trade the chart, not your P&L. I started trading really well and saw big improvements in my own performance when I focused on the process of trading well rather than the P&L or the results per se. If you trade well and focus on procedural propriety to some extent, the results tend to align. Okay? And the market doesn't care where you entered or your exit or your risk reward or any of those things. It's agnostic as to your particular circumstances. If you're a technical trader, which you probably are watching this video, we're here to trade the technicals, and trade management is no exception to that. This video complements the lesson on entry triggers. It also complements the lesson on risk management and a whole lot of other lessons, so I hope you're not watching this first. If you are, you're committing a mistake. Please go back and watch the videos in order. That's for your benefit. So all my content is of limited use in the absence of screen time, but trade management is especially so. I really think that even if you're trading, rather than trading a paper account for years and years, I think it's a meaningful difference to even get, 10, 15, 50 pounds, whatever it may be, an amount you can really lose, and practice managing that in a real environment. I mean, a non-trivial amount that you can afford to lose would be ideal, but I think any live management experience is better than none, even if it's a small amount. So screen time is really your friend when it comes to these things, and that's really where you'll develop and refine your system. So let's get into it. The definition and context, quite simple definition. Trade management, a set of decisions made between opening a position and fully closing it, right? That whole time space. So in terms of scope, this video does not explicitly address the list you see there. There's kind of more advanced strategies, compounding, pyramiding, laddering. We don't talk about automated strategies here because we're all line box drawers, right? Technical traders. When, how, whether to scale in and out of positions. Again, position allocation to some extent. That's more an entry triggers type of video, so that's not covered here. And I'm going to try to keep this reasonably short, so can't go over everything, unfortunately. And as you can already probably tell, it's a hard video to make because management is so closely linked to one's entry and how one's system operates generally. It's quite hard to foretell and foresee all the possible variables. It's impossible, actually. So I'm going to try to be as broad as possible to encompass as many different trading systems as I can, and so we all get takeaway points that you can apply no matter how you trade. However, manual traders with a price chart focus and a system allowing for some degree of discretion will benefit most from this video. And I think if I have the privilege of having you as my audience and you've learned something from this channel, or your foundations started here, whatever the extent of your involvement, there's a good chance that you'll learn something here, or it will in some way be applicable. Now the aim, as I said, hard video to make. What am I actually going for? This isn't the type of video, as you'll know from this series, that this is how I do this, copy me and you'll make money. That's not what we're talking about here. I'm trying to provide a framework for thinking about trade management which spurs independent research and addresses common errors. So this is just to get you thinking along the right lines, and if I've done even a half decent job, you go and experiment and figure stuff out for yourself, just like I did. So as per the first bullet point in the outline, what do I mean by an evidence-based approach? I'm not really talking about the scientific method here, but I mean two things by that when it comes to trade management. The first is, before even getting into the whole discipline, you need to investigate whether you would benefit from actively managing your trades. So if you keep any sort of trading journal, that's a fairly straightforward process, and indeed you probably know the answer to that. If that doesn't make any sense to you, just on a surface level, if you actively manage trades, is it to your benefit? I know a lot of journaling software can actually give you data and simulate trades and outcomes if you hadn't managed them over a certain time period. And as it says on the slide, what would returns be over X trades if left to original entry target stop? At the same time, if you're not actively managing your trades, could you benefit from doing so? Does your system offer you early exit signals or take profit signals that would be to your benefit that you're choosing not to ignore or aren't part of your system because you play on the set and forget side of things? So that's the first thing, what I mean by evidence-based approach. How does or will trade management, or specifically does in its current state, trade management affect your trading? Is it to your benefit? Is it to your detriment? Where do you lie on that spectrum between set and forget versus a more interventionist model? Okay. Now the second meaning, and the one that's going to be relevant for most of this video, is the evidence sort of for your position. So once the trade is opened, reassessing the chart and the technicals to see how you should manage the trade. And so the question, as I've articulated here, are developments in price since my entry aligned with my expectations for this trade idea? So is the chart doing what I expect it to do if I'm right, essentially? Now that sounds very obtuse when said in a vacuum, but as you can see, I've added some bullet points and some examples there. Is price reacting as expected to my technical structure or its break? Is price moving in the expected direction within a reasonable time period? Is price breaking support resistance or making new lows highs, etc., etc.? So as it says at the bottom, just a few examples, but the idea is to exercise your discretion to always be reassessing whether the evidence, which for us as technical traders is the price action, supports your position or goes against it. So from a trade management point of view, if price is developing positively, so in the direction of your trade position and in line with your expectations, then that's fantastic, we manage accordingly. If it isn't, we also manage accordingly, as will be explained in the coming section. So that's kind of an important thing to bear in mind. Evidence-based approach. We're using our discretion to always reevaluate, does this position still make sense? Is the argument for being bullish or bearish just as clear, less clear, even more clear than it was when the trade was first opened? How are things developing in contrast to our expectation for this trade. And the obvious logical implication is that if we have a certain expectation for price and there is no alignment, and indeed you're getting conflicting evidence for your position, we're going to look to close that out before a full size loss. Okay, so it's not like we opened a position, we're assessing all this evidence, everything is screaming that your position is wrong, and we just sit there saying, well, I've got a stop loss, that's going to be okay. That's not what we're going for here, and that's not the kind of trade management that I think most manual discretionary traders will benefit from. Okay, so that's what I mean by an evidence-based approach. Probably the most common topic when it comes to trade management is the topic of timeframes. And for those of you who are worried already, we will look at some charts. I think 3 trade examples once we go over the slides and kind of bring it all together. Okay, but back to timeframes for now. This section addresses the topic of what timeframes to employ when managing trades, right? Now, in terms of the model used, I'm just going to go with candle closes. I think it's very common, even non-technical traders, weekly close and daily close and all of that type of stuff, whether a level's been broken based on candle close, pretty orthodox stuff. So we're going to roll with that. Not saying it's mandatory, but it just makes teaching this easier. Okay, so with timeframes, and I strongly recommend you watch the video on timeframes again before this video, because much of this section won't make too much sense unless you've seen that. But the competing considerations in timeframe management is essentially that if the time frame is too high, you may miss out on management opportunities. If the time frame is too low, you'll overmanage and fake yourself out, and excessive management is the risk, right? And you'll see that a lot. Someone enters as a swing position on the daily or weekly time frame, which could take weeks to unveil or materialize, and they're out of the trade on the next hourly candle because it looked scary, right? That's the kind of opposite risk. How do we get about that, or how do we balance these competing considerations? Well, the management time frame is to some extent at least contingent on the time frame of the trade itself. So in a broad sense, intraday trades will require intraday management, so we can actually do something about the position before it moves too far north or south, right? And then higher time frames obviously will be suited for higher time frame management. Sounds fantastic, but what does that actually mean? Here's my own practical tip that I use. Feel free to adopt this, play around with it. It's not some law of nature, as it says below. But for a weekly setup, managing on the entry time frame, so the weekly time frame and a time frame below, so the daily, that's a good starting point for your studies. Similarly, for the daily time frame, managing on the entry time frame, the daily, and then maybe one intraday time frame lower, like the 12-hour, 6-hour, even 4-hour in this example is fine. And then for our intraday trading, again, 4-hour chart, hourly chart, using those same time frames or a smaller intraday time frame, 30-minute chart, 15-minute chart, I really think is a nice foundation or starting point to be along the right lines. Okay, and as it says here, play around with it, experiment, but it's a solid foundation. For me personally, I kind of run a hybrid system, so I'll be trading high time frame levels from the daily and weekly, but a lot of my entries and management will be on the hourly time frame. And I've found if I'm trading high time frame areas where price is going to naturally spend more time, the hourly time frame actually gives me plenty of time and evidence to react and reassess and do all of the stuff that we talked about in this section. Okay, it gives me a fantastic opportunity to track these developments in price and get in and get out before the daily impulse plays out, much of the time anyway. Okay, so that's the framework there. Another part of the framework is managing both sides of a trade. This is really important, probably one of the more neglected parts of trade management. And what I mean by both sides of a trade is that managing trades that are at a loss, so before they hit your stop loss order, as well as those that are in profit, so prior to take profit order. It's so common to see traders rush to manage a trade and move their stop and lock in profit and take off some size and do whatever else. As soon as the trade goes onside, they become the most interventionist people in the world. But yet if the trade goes against them, they take some heat, they sort of pretend it's not happening and they don't see it, and, oh, well, I've got a stop loss, that's what it's there for, it's none of my business. Which is unreasonable in my view, or at least somewhat contradictory. If you can exercise your discretion ahead of a take profit order, why doesn't it work the other way around? And of course the answer is that it does, it's just most people choose to ignore that. To their own detriment, I believe. because consistently reducing 1 hour losers to less than a full size stop out will make a meaningful difference to your equity curve, and it will make you a better trade manager. So you'll see a lot of newer traders when you look at their trading journals, or if they're posting results, you'll see, plus 2R, plus 1R, plus 3R, and then it's like a streak of -1, -1, -1, -1. But then you'll also see plus 0.8R and plus 0.5R. So they'll be managing the winning side of the trades, but then erasing more progress than they have to by just taking the losers on the chin and doing nothing about them. And I'd encourage you as a trade manager to consider both sides of the equation. So some examples of that, or instances where trade management could come into the equation. So specifically the losing side of things. So before price hits your stop, you can see 3 examples there. Let's say you sold a level of resistance, price has flipped it and is using it as support. At that point, the probability that your trade is correct has reduced significantly, and you can jump out ahead of your full stop loss, and then you can always get back in if that level is once again reclaimed as resistance, right? Or maybe you faded an impulsive move into intro structure. That should not say intro structure, my apologies. Into structure, there we go. With sellers nowhere to be seen, right? Again, price not aligning with our expectations. Or another example, very weak reaction at support, followed by closes through it. If you're seeing that type of price action as a buyer, there's no reason for you to, in every single instance, wait for your manual stop loss to be hit, because as that price action is developing, the probability of your trade being correct is decreasing, right? So don't surrender to fate. You're not a Soviet grandmother. Those of you who are familiar with that culture in many regards will know that they use the dismissive "no это судьба." It's just fate. Don't be like that. We can do better. So let's look at a chart example of some of these things. I actually remember from watching price action at a weekly level. So I'm just going to quickly delineate. We've got this consolidation in Bitcoin dollar. I was watching this range, highest close, lowest close, on the hourly time frame, as I outlined earlier. This was here when price really first came into the range. So you can see on this rally into the level, at the time, I was anticipating the 6150 level here to act as resistance, right? So let's then look at the price action at the level and keep in mind our checklist of, is this aligning with our expectations? Is resistance acting as resistance? If we're expecting this level to force prices lower, are we getting bearish price action at the level, etc., etc.? And you can see here, and by the way, this was a fantastic range to trade because you had really clear contrast between these two levels in terms of them doing their jobs. So you can see on the underside of the level, you had a close through the level, okay, another close through the level, pullback, found support, you're getting consecutive closes above it, another pullback, you get a nice hammer, close above. So, I mean, if I were to just show you this price action in isolation and just say, here's a line or here's a level, is price here using it as support or resistance? And you would, of course, say support, right? Even at its simplest, not a single hourly close below the level is evidence that the level is being used as support. You even got like a very bearish trap type of setup where you had a spike through the initial high made, and even that wasn't enough to break the level. So this is bullish price action at a level of resistance. So if we're selling here, that's evidence of price not being aligned with what we'd expect, okay? And then the actual trade I took at the level was at 67.01. I think this is on Twitter, where I said weakness below 6,700 and then posted the breakdown. But let's compare those two. Here, first test of the level, closes below it. You get an impulsive push through, close above, okay? Then this candlestick here, I don't have a clear read on that. I don't think it matters too much, but I'm sure some candlestick expert could come up with a reversal argument for it. And then we pretty much have the opposite of what we had at the lower boundary. We have a close through the level, retest, close below, another close below, and then comes back to the level, close below it once again, and then you get your impulsive engulfing candle through it. Okay, so that's kind of what I mean by price action at a level and using our discretion to make a judgment as to whether the level is performing as it should if our idea is correct. If your idea is that this level at 6150 is resistance, you're not getting any alignment from price because it's actually acting as support very clearly across, half a day, for example. All the closes above it, all the bullish price action, etc., etc. The 67 level is the complete opposite. From a trade management point of view, even if you shorted the breakdown, this first hourly close below it, which was my system's first entry signal here, okay? From a trade management point of view, once we're here with a stop at the high, is there any reason to think that this level is now acting as support or that price action, while we're expecting bearishness, is somehow bullish? Well, no, because it's acting as resistance, all the closes below the level, right? So that's kind of a quick insight into how my system works. I'll have high time frame levels, and then when price comes into them on the hourly time frame, it usually gives me ample time and opportunity to position, and even once positioned, assess and reassess whether I'm on the right side of a structure. Okay? So those examples you could see, sold resistance, price flipped it using a support. Clear example of that at 6150 weekly level. And I'm sure in the other examples we'll see some of that as well, some of the others. Okay? So that's what I mean by managing both sides of a trade. And just a general trade management example there as well. Time-based management, again, very important. And the central premise for this is that some trade ideas have an expiry date. So while price-based management is intuitive, kind of is number go up if I'm bullish or number go down if I'm bearish, some trade ideas are actually time-sensitive as well as price-sensitive. They're not mutually exclusive. So time-based management is managing trades that do not materialize within their given window. So in these cases, if you're not seeing what you expect to see when you should be seeing it, that in itself can be an exit or management signal. That doesn't make any sense, don't worry about it. 3 really clear examples, at least via bullet points. I'm not sure what the charts for these are. So, for example, setups premised on trapped traders. If you've watched the order flow video or the clean double close or any of my live streams, this kind of stuff should be familiar. So you've got your swing failure pattern, failed breakouts, price trading beyond the value area or liquidity pool. All of those setups assume a fast rejection if the setup is really a trap. Because the whole idea in those setups is that market participants induced or who end up on the wrong side of the move, right, or the breakout traders, however you want to classify them, they get squeezed. And so if it truly is that type of trap squeeze setup, there's a certain time window in which the setup has to materialize. If it takes too long, as it says at the bottom, as more time progresses, the probabilities shift from trap to genuine breakout. Because if it is a trap, the time window for those guys on the wrong side to get out at break even or at a mitigated loss should be quite low. And the more time that they have to get out, the less compelling the setup, if it is indeed a trap. Okay? If that didn't make sense to you, the order flow video, I'm sure, answers many of those questions. Setups premised on momentum continuation. So market structure, your higher highs, higher lows, range breakouts, or closes through key levels. Those types of setups assume aggressive participation, i.e. price not stalling once structure is exceeded. Okay? At its simplest, we don't need to look at a chart for this. We have, let's say, a key level of resistance. And let's even say that price has hit it a couple of times already. And we're coming in for the 3rd time. And then finally we get a candle close through the level. Okay? If this is indeed bullish, it's not going to spend a lot of time hovering around the level because the sellers are on the wrong side. And the more time they get to mitigate being on the wrong side of a breakout, the less compelling the breakout itself. You get really the high velocity and fast setups tend to form where traders are forced to make a decision, not when they have the luxury of closing something that hasn't gone their way. So that's your momentum continuation example. And then also setups premised on support resistance or equivalent structures. So if price spends too much time at a structure without offering a reaction or moving away, the probabilities shift from bounce to failure. And there's another chart example for that here. A trade which I had to scratch for a small loss, but ultimately ended up saving me quite a bit, because had I not done so, the loss would not be small. So it was this 6900 level here. Daily range low, support resistance pivot, very important. Okay. And we can look at the intraday price action. Again, insight into my system. I'll typically use the hourly time frame at high time frame levels to get my read. And you can see it was an important area of support resistance beforehand anyway. Then we got price breaks above it, rounded retest, catches a bid into the first trouble area, okay, and then falls through, and the level is once again resistance. Okay, and you're getting test, no break, higher low, test, higher low, test, higher low, right? Roughly, it's not perfect. Certainly the last two are a bit more compelling, but either way, even if not higher low, there's no breakdown, right? The initial low that was made on the breakdown is holding despite price testing the level over and over again. So then when this breakout happened here, I actually took a trade, which wasn't a fantastic trade, but I'm happy to talk about that anyway, to fade it here, which is at this prior area of support and resistance, and this is the top of a 4-hour consolidation as well. Now, I think the way I actually delineated the level was like so. This will be a good one to talk about. So this is the 6900 level, and I had two other intraday levels here, delineated as such. Okay, so I sold at 70.70s, and I was anticipating a very quick move from this price structure here, this confluence of resistance levels, okay, back down to 6900. Which I technically shouldn't have taken, given that the daily had already closed above 6900, but either way, just let's look at this trade in isolation. I'm anticipating resistance within the red box, okay, and instead I cut the trade, I remember, before this leg down here, so within this price cluster here. Why? Well, we go back to the first thing we studied in this video, which was alignment. Is price aligning with my trade idea if it is correct? So in this case, I'm selling resistance for a fast move down back to 6900. We can then look at the price action, exercise our discretion, and say, does this look like bearish price action given I'm short? And instead, as you can see, there was acceptance at the level and consecutive candle closes and even a short-term break in structure as a higher high was made. Okay, then price briefly dipped below. I felt like an idiot for a short time for cutting just below the break, but then that proved to be the correct play as we got this leg up. Okay, so just another example of what I mean by, is price doing what you'd expect it to do if you're right? If I were right, selling this structure, I'd expect something like a spike, maybe this little, doji pin, whatever you want to call it, shooting star candle to form, and then a fast move back to the level that I had as my objective. Instead, total lack of alignment as this area was used as support. I cut the trade, quick dip, and then straight up. Okay? So that's a good example of point number 3 of setups premised on support resistance or equivalent structures. If price spends too much time at structure without offering a reaction or moving away, probabilities shift from bounce to failure. In this case, it was even more extreme, because price wasn't just consolidating at resistance, it had actually broken through it and was being accepted above it. Okay? So even more extreme example in this case. A pure example of point number 3 would be quite simply a level of resistance that we expect to do its job. Price comes into it, hits the level, and then simply starts ranging at the level itself. Okay, maybe even making higher lows in the process, eventually exhausting supply before breaking higher. Either way, whichever example you want to use, either the chart example from my trade, where the level was actually broken and price was above it, or this little diagram here of the level failing it to do its job, because if resistance is going to do its job, we'll get a lower low and a breakdown, right? So consolidation at resistance, assuming the appropriate time frame, is not bullish and not what you'd expect at resistance typically. Okay, that's what is meant here by if price spends too much time at structure without offering a reaction or moving away. So that's time-based management. Now, in terms of profit-taking methodology, as a facet of trade management, just a couple of the mechanisms for exiting a profitable trade. I'm sure there are loads more that I missed. Take profit order being filled, obviously. Manually closing a position at market. And then a stop order above entry if long or below entry if short. So basically an onside, a stop that's been moved into profit being executed. So technically, you can trade and never take profit, and instead continually move your stop as the market moves in your favor until you are stopped out in profit, right? So let's look at a 4-hour chart example, not a live trade of mine or anything, but just something structurally that makes sense. Let's say you got long on the breakout through this consolidation here. One moment. This consolidation here, or this range breaks out. You decide to get long, and then you anticipate a trending environment, so you trail your stop under each swing low. This would be the first one, then price come down, make another swing here, and then here, etc., right? So you'd never technically have to take profit on a position, because all you do is move your stop up. Good chance you'd get taken out here, then you can always get back in, etc., etc. That's, forget the specifics, it's kind of the structure we're looking at of not having a fixed take profit, saying, okay, I'm going to trade from this range to this level here, but rather saying, okay, we've broken out of the range, decent argument for a trending environment there, so I'm just going to keep moving my stops up until I'm taken out. Okay, now what are the risks with that approach to profit taking? Well, it assumes a trending environment, first of all. It also assumes that clear levels for new invalidation will form, which isn't always the case. And lastly, obvious areas for trailed stops often get tagged prior to trend continuation. We saw an example briefly, or an arguable example of that in the Bitcoin chart, but generally whenever you get very, very clean technical trends, higher highs and higher lows, there will often be some event, kind of a shakeout or even a deep trend retest, whatever you want to call it, which will knock those participants out of the dominant trend if they've been employing a very simple kind of trailing stop strategy, right? Now, there's no right or wrong way, but it depends on your trading style and market conditions, among other factors. Whether you kind of move stops or explicitly take profit. That's why I've got the verses depicted as such, because it's not a strict dichotomy between those two things. They're not mutually exclusive. So a trend following system in a trending market, you're more likely, I think, to capture a bigger portion of a trend with trailing stops. Because if you are indeed in a dominant trending environment, why would you try to catch the top or even give up a good entry if levels of resistance are being broken as price is making higher highs and higher lows? At the same time, a more kind of mean reverting, or I suppose a orthodox, or what most people would understand when I say a swing trading system, maybe in a ranging environment, fixed profit taking at range boundaries or ATR or however you want to delineate the range, or where you might anticipate resistance, that makes more sense there, right? So for example, if you have a ranging environment, price trading between two levels, if you manage to get long near the range low, your objective or profit taking area will be the range high. Because judging by preceding price action, if you've got no good reason to believe the range is going to break out, if you don't take profit at the range high, all you risk is price returning to your entry or even stopping you out. Okay, so trade management, specifically the profit-taking side of things, or moving stops, or however you want to, paying yourself, however described, it's unlikely that you find long-term success with just one system for all instruments, all time frames, and all market conditions. You should have at least a couple in your toolkit. One to be able to catch and not give up entries if the market's moving in bigger waves, if you will, and one for kind of bracketing or range-bound environments where you don't get too greedy and take the level-to-level trades. Okay? Another important consideration from the risk management video, and again, I first came across Tom's articulation of dynamic risk-reward or evolving R, And the premise here is that the risk reward of a trade is not static. It adjusts as soon as the trade is live and price moves away from entry. So it's a dynamic calculation. So the question to ask yourself as the trade is developing is the risk reward of the trade still reasonable in its current state, not the state during which the trade was taken at first, right? If you take a 1 to 2 risk to reward trade and then price moves significantly towards target or significantly towards your stop loss, that risk reward has changed as price has changed. And one way to think about it is the following kind of thought exercise, if you will. If someone offered you the current price, your current stop loss order, and your current take profit order as a trade, right now, would you take it? And if the answer is yes, then that's good. So your risk reward and trade management is reasonable. If the answer is no, now what I've written here is quite extreme, that, well, yes, the risk reward of the trade is less favorable, so manage it, either by moving stop loss order and or by taking profits. It's not always going to be an impetus to manage the trade, but it's to keep you thinking about the dynamic nature of risk reward in a trade. So let's look at just a quick trading view example without anything specific. Let's say you enter a long position. Okay. With these, you know what, let's make slightly better risk reward here. Risk reward of 2. Okay, forget all this. This is our trade. Risk reward of 2. Entry, stop loss, target. And then price moves in your favor and moves, let's say, to this level. So now we're technically recalculating the risk reward because this is your entry. Your take profit is the same. And your stop loss, if unadjusted, is also the same. So when the trade started, your risk reward ratio, or you had an R on the trade of 2, right? You'd make double whatever you're risking on the trade, you know, fees, commissions, etc., if the trade were to go to target uninterrupted. Now, if you let the trade come this close to target, so move from this point to this point, and you haven't moved your stop or done anything to manage the trade, then you are risking this much extra profit at the expense of a full-size loss all the way down here, right? So you can see the risk-reward calculation becomes unreasonable. Now, that doesn't mean if you move your stop, it has to then match 2 or be some amazing risk-reward at all times, but this is just to get you thinking in the right mindset that when I took the trade, the risk-reward was fantastic. Now it has progressed to this level, and if I do not change anything, either take some profits or move up my stop or manage the trade in some way, suddenly the existing risk-reward of the position is not reasonable. I don't think any reasonable person, if I asked you as a fresh trade and offered you an entry here, a target here, and a stop loss here, most people wouldn't take that. Reasonably so. But if you're in it, if you took this trade and price gets to this point and you haven't changed anything, that is the trade you are essentially agreeing to. Because price is under no obligation to hit your take profit order. It doesn't care about you. It doesn't know who you are, right? So it could reach this level. You only have this much left on the table in terms of profit for this much risk, and then it reverses on you and takes you out. Okay, so it's always important to be cognizant of the dynamic nature of risk reward and how it changes both in terms of price approaching target, but also in terms of price approaching your stop loss, as mentioned in the preceding section. Okay. As I said, dynamic risk reward is also especially important, at least in my experience with trading Bitcoin, when you really get on side with a big thrust candle, so an expansive, engulfing candle with a big range, essentially. And the same considerations then creep in. How close is the trade to target? Where is the nearest structure I could use to define my risk, if any? And if there's no new invalidation level whilst being so close to target, as we covered in that example there, is the risk reward justifiable? And here's another example you could kind of draw yourself. I sort of did a different one on TradingView, but 20-point stop, 40-point target, price moves 35 points in one candle, 5 from target, right? So at that point, you can see the change in the risk reward, given it's dynamic. It's gone from a 2-hour trade, and then suddenly you are risking the entire position for an extra 5 points of profit, at which point that is unreasonable. And again, it's not like you have 2R in the first trade, and then you measure your dynamic risk reward and it's not very good, and you say, oh my gosh, I have to move my stop or take profit to make it to turn it back to 2R, it doesn't work that way. You don't have to kind of restore it to its original value. It's just to get you thinking about the trade and managing it so that you don't give up gains unnecessarily, and you certainly don't take your position for granted. So the risk reward is always evolving in trade management. Okay. Another very contentious facet of trade management, risk-free trades. Okay, so the premise is moving a trade to break even as soon as possible after it moves positively away from entry, so in your direction. And so the idea is doing that removes all risk from the trade. It becomes a free trade. Okay? Now, when does moving to break even make sense, at least in my view? Two main scenarios, really one, which is the first one. The second one I think is arguable. The first one is when your technical invalidation level for the position aligns with the entry price. And again, unless you've got a really good entry, that tends to be quite rare that you get that almost perfect alignment. Okay? And as we'll see in the next section, even that's not always perfect or a good idea. Now, the second scenario is where price has moved significantly away from entry, but not provided a new invalidation level. So that could arguably be that example at the bottom of this page here, where your price moves in one candle, basically to your take profit order. What do you do? Now, honestly, for my personal trading, in those cases where price gets really close to my take profit, starts showing signs of reversal, and I've got nowhere to define my risk and nowhere to move my stop, I'll usually just cut the trade. I'd rather leave that extra, 2, 5, even 10% of profit and get out of the trade rather than let it come back to me and take me out break even, given I've not been able to define my risk elsewhere. Okay? But you could certainly make the argument that when those scenarios happen, break even is justifiable. I'm personally not convinced, but I'm happy to share the argument with you. Now, reasons to be skeptical of automatically moving to break even, I think there are a few. The first is that it's not risk-free. Now, the actual technical exchange mechanics aside of, fees and slippage and all of that kind of stuff, assuming perfect order execution, which certainly isn't guaranteed, from a technical point of view, the risk, it doesn't become risk-free, it's just the nature of the risk changes when you move your stop to break even. The risk becomes getting stopped out while still being right before your idea can materialize. So you're essentially not giving your idea a chance to play out. You're not letting yourself be correct. And that applies in many types of technical setups. And we'll cover one in a moment. But it's especially true, as you can see in the second point, in my experience, price will very often retest technical structures, especially if they are high time frame levels. It may look on a weekly chart that price came into a zone, wicked into it, and then reversed. It looks fantastic, easy. But often, if you look at that same weekly wick on, let's say, a 4-hour, hourly, any intraday time frame, you'll actually see multiple tests of that structure before it eventually leads to a move that does its job. I'm sure you can go on my Twitter or other feeds and find examples of this, but roughly what it looks like structurally, if I may, is you have your high time frame level. So this is high time frame, okay? And then we're on an hourly chart. So price will trade into the level. Then initially, the first impulse will usually, give you some sort of decent reaction if price has reached a key level. And at this point, traders who sold into it will be quite happy with that and say, wow, market was trending up, looking beautiful, hit the level and fell. That should be the top because this level's done its job. And what they'll do is move their stop to break even or slightly in profit even, okay, and saying, well, look, we've pulled back from high time frame resistance. That's it. It's done its job. And then often what will happen is price will pull back, maybe spike the high, come back, maybe give some distributive price action before then falling off and giving the real impulsive move as opposed to the initial impulsive move. Now, what all of this looks like on a weekly time frame, as mentioned, it looks very easy. It just looks like a wick and then price turning away. But on an intraday basis, you get these sort of scenarios where you end up selling, or you essentially end up buying resistance, right? That's kind of the point I'm making with this point here. Not only will price very often retest technical structures, but you end up buying the resistance you sold or selling the support that you bought, right? Just to make that very clear, we've got a high time frame level here. Okay? Prices come into it, sold off, and you move your stop to the level. If you're short with a stop market order, if that gets triggered, that's an order to buy at market. So what are you doing in essence? You are buying at resistance. Okay? Especially again, when you're dealing with intraday price action at high time frame levels, these sorts of retests, spikes, distributions, etc., they'll be very obvious on intraday time frame, but on the higher time frames, it'll just look like a wick. But if you end up giving too much weight to this initial impulse, right, the first reaction, and then you immediately move your protective stop into profit or break even, if that then gets executed, you end up buying resistance as you get stopped out of your short at the same level that you sold initially, which doesn't make any sense to me, at least. Okay? And finally, a slightly separate point is you're fettering your discretion and abandoning your technical trading framework if you just automatically move to break even without having a technical basis for doing so. Okay? As mentioned, it's not automatically the case. Sometimes if your entry is really good, it will align. But in many cases, it's just a coping mechanism. The market doesn't know or care where your break-even level is. You have the technicals to guide you for your trade identification, for your trade entry, all of those things, you know, where you look to take profit. So why is it suddenly that when it comes to trade management and your stop placement, the technicals go out the window to make you feel good? And indeed, as mentioned in the previous example, you end up doing the opposite of your technicals. By moving your stop to break even, you end up buying the resistance that you were selling at first. Just worth being cognizant of. So some trade management psychology and tips. These aren't perfect. I've kind of tried to summarize bits and pieces and bring it together, so maybe rewatching the video will be better for you. So focus on good trading. So the trading process, following rules or a framework. Now, I understand some viewers might be confused. I'm talking a lot about discretion, but then talking a lot about rules. How do you square that circle? It's not very easy. I found one of two ways tends to kind of take over. The newer traders usually start by being fully discretionary, then they get pretty systematic, okay, as they develop a framework from their trading journal, etc., come up with strict rules and scenarios, etc., and then they either stick to that and remain kind of on the more systematic side of manual discretionary trading. So it's still manual, they still have some input, but for the most part, it's much clearer and more explicit what they look for and what they can trade and how to manage it. And on the other side of the spectrum is, again, those who started off very discretionary, toyed around or spent an early portion of their trading career on the systematic side, and then with screen time and with experience, lent more towards discretion, which is kind of where I find myself and many of the guys that I trade with. Okay? But just to make that clear, there's no contradiction between developing and following rules in the framework and at the same time exercising discretion. There's nothing wrong there. Now, in terms of focusing on good trading, the trading process, trading your P&L becomes an emotionally driven and actually worse, an unreplicable endeavor. The whole benefit of technical trading is you kind of know what it looks like to some extent, and you can replicate it, you can backtest it, you can know roughly when setups are similar, okay? If you're more on the discretion side of things, you know what to see. Whereas if you're trading your P&L, your emotions at the time, your exact sizing, the numbers on the screen, how quickly your P&L changes, none of that is easily replicable. So that makes it harder to trade well. And as has been a recurring theme throughout this video, the market does not know or care about your trade parameters. They're irrelevant. And as we saw in the previous example, in the previous slide, you might think you're doing good risk management by setting your stop to break even at that high time frame level, but from a technical point of view, you are buying the resistance that you first sold, or selling the support that you first bought, being the inverse example of that. Now there's the question about a good entry, sort of how important is a good entry for trade management? Somewhat. I would say. At least it's not irrelevant. So anecdotally, I think for anyone and everyone I've talked to, and certainly for me, it's easier to manage trades which take less heat, right? If you get a nice entry and then price reacts well to it, you're probably going to give it a bit more leeway in developing. You're less likely to overmanage those positions, okay? That doesn't mean you set your stop to break even automatically, right? Certainly, it's more likely that you can justify doing so, but it still shouldn't be the automatic reflex. But as I said, anecdotally, casually, it's kind of less stress. You get some early indication that you're on the right side of the market, given it's impulsive in your favor. It helps. It helps. Another tip, especially after watching a trade management video, is make sure there's something to manage. There's a bit of a dead zone, I've called it, between your stop loss and your take profit once the position's live. And your job there is kind of to do nothing. Price will kind of oscillate a bit and give you a bit of heat, then go onside, give you a bit of heat. You know, at a certain point, yes, you'll start doing your evidence building or evidence assessment. You know, is this aligned? Is it doing what I expected to? Does this trade still make sense? Etc., etc. But really, especially soon after entry, there's a good chance that for a bit, depending on the timeframes that you trade, there's nothing for you to manage. So let your idea play out and let the market kind of digest, which is a terrible word to use in trading, but here we are. Make sure there's something to manage. And certainly if your time frame game is terrible, you know, if you've taken a daily time frame trade and then you're suddenly on the M15 trying to move your stop, I mean, don't. Especially with high time frames, things can really change in like one candle when dealing with high time frame levels if you're on the right side of them. So patience is especially warranted in those areas. The last one, again, quite behavioral. The market doesn't know or care whether you've been losing or winning. Again, a tricky one in terms of discretion versus being systematic, but trading in contravention to your established system based on previous trades is sacrificing good process for P&L comfort. Not sustainable, not recommended. Trade your system, trade well. Do what you know is good trading, right? Execute your profitable system. And if the market's kind of been scratching you and, you know, you've been mismanaging other trades, the market doesn't know that you've been mismanaging other trades. So why don't you just start doing it properly? Psychologically, it's very difficult, right? Let's say you get a big win. Let's say you've been getting scratched in a session, you know, minus 0.1R, fees, all that type of stuff. And then you get a runner, one that makes up for all the preceding losers. And your system is telling you to hold it, but you might want to close it because, oh my god, my UPNL, I can make back everything I've lost. I would say in those circumstances, as far as you can, defer to the established system and the process, right? The high quality trading process rather than trading your P&L, okay? If you can, just trade without your P&L at all, right? Assuming you can still size properly. But once you're in with your risk parameters, just get that thing off your charts. Probably not going to help you, okay? Conclusion. By the way, I cannot believe I've recorded this in my first take. I hope I didn't jinx it. But trade management is not easy. Okay? Screen time and live experience are irreplaceable. Your trading journal, all these factors that come around in a live environment, those are going to be far more valuable than YouTube videos, books, webinars, whatever you want to call them. Okay? Even from a paper trading point of view, if you can, with money you can afford to lose, even live managing any sum, ideally a non-trivial sum that you can afford to lose, but any kind of live trade management will just give you experience that you wouldn't get elsewhere, even with paper trading. There's just something different about it. Try it out if you haven't. Okay? Again, risky, you can lose all your money, etc., etc., but if it's something that you can invest towards learning trade management, an amount you can easily afford to lose, I think you'll learn much quicker than doing it purely via paper trading. The second point, again, we're kind of summing up recurring themes in the conclusion, is if you're a manual trader with room for discretion, use it, right? It's to your benefit, ideally, if you've employed this type of trading style. And as we saw in the chart examples, we like to reassess and reevaluate the trade with fresh eyes in terms of price developments as well as risk reward, right? Is this resistance acting as resistance? Is this support acting as support? Is price behaving at this level as it should be if my trade idea is correct? And if it is the risk reward, which adjusts dynamically, if I recalculate that, does the trade still make sense? So this whole process of trade management is all very live, dynamic, and relies on you, right? It's not something that, the trade is filled, it's trigger, and then you leave and that's it. You're in God's hands, et судьба, all of that type of stuff. That's not how it works. Again, maybe it is in rare cases. Maybe you are that person watching this video who overmanages all of his trades, and maybe set and forget for you and your specific system works well. But I'm fairly confident that many people would benefit from looking into trade management practices, and I'm sure there are trades that you could have gotten out of early or closed in time that went against you that could have gone better if you had a trade management framework. I say that with a reasonably high degree of confidence, okay? So if you have room for discretion in your system, use it. Trade the chart, not your P&L. I'm not going to bang on about that, but again, the long-term focus should be on the trading process. Trade well, and if you do that, the rest tends to align, okay? At least if you trade well, and even if the P&L stuff isn't aligning, you know what to work on. You've got replicable, clear data on what you're doing, rather than the emotional swings that come with P&L trading. And for me personally, just on a finishing note, the kind of things that go through my head, as you saw in those examples, when I'm in a position or looking to get positioned, is price action developing as I would reasonably expect it to, if my trade idea is correct, and what is the evidence for or against my position. In a kind of cringy way, I think about it as almost from a law point of view. What are the arguments, or debate? What are the arguments for? What are the arguments against? Have the arguments shifted in one side? And where is kind of the evidence pointing towards on balance? And that's trade management for me in a nutshell. So thank you for watching. Glad you've made it this far. Social media tags, etc., as you can see there. It will help me a huge amount if you leave a like and any comments and feedback on this video. It really, really makes a big difference. So I'd appreciate any and all of that. Thank you for sitting through another technical analysis educational video, and I hope to see you for the next one. Take care, stay safe.